Forex volatility is the frequency and extent of changes in the value of a currency. It measures how rapidly a currency pair swings up and down. When a currency's price fluctuates wildly up and down, it is said to have high volatility. When a currency pair that does not fluctuate much, it is known as low volatility. There are few factors that cause volatility which can affect forex trading. One of the major causes of volatility is geopolitical factors such as wars, uprising, riots, and other forms of unrest. Second, the trade wars, whether they are between the US and China or any other region or country, can also lead to market volatility due to billions or trillions of transactions involved. Third, the monetary policies. Central banks all over the world play an important part in managing the flow of money. Volatility will always increase whenever an interest rate decision is announced or a meeting is held. Keeping an eye on central bank decision is important for every forex trader. Furthermore, the market sentiment is also plays an important role as the market movement is driven by traders and investors around the globe. Price fluctuations are likely due to increased volatility in the market, whether it's a positive or negative sentiment. To trade with volatility, there are few tips. First, use stop loss orders since they protect you if something goes wrong due to volatility. Second, monitor the economic calendar so that you can anticipate volatility at least to a certain extent. Volatility is a part of the market movement, so traders should decide how to react when there is volatility. Typically, traders wait for a pullback after the news to open a position. The final tip is to limit your leverage. Leverage is a double-edged sword as it can magnify both your wins and losses. By limiting it, you are taking a step to mitigate risk.